In a move that has been described by some commentators as savage, National Savings and Investments have slashed interest rates across the board, taking some rates down as low as 0.01%. In this video, I explain what has happened and what you should think about next. Hello, I'm Martin Bamford from Informed Choice. I'm a chartered financial planner. In this video, I explain what's happened at National Savings and Investments, who have slashed interest rates across the board, and some things to think about if you're a saver considering your options. 2020 does appear to be the year that keeps on giving. We've had a global pandemic, and now savers, with the global economic recession looming, appear to be in for a very tough time of it, with interest rates slashed at National Savings. Lots of savers, of course, moved to National Savings in a bit of a flight to safety because National Savings are backed by HM Treasury, but now interest rates are going to be cut to incredibly low levels. So here's an overview, first of all, of what's taking place. And most of these changes take place from the 24th of November 2020, and we're seeing cuts applied to both variable rate savings products but also guaranteed products at the time of renewal. For the variable rates saving products, and these include the ISAs, the junior ISA and the direct ISA, here's a summary of the cuts. For income bonds, the interest rate is being cut from 1.16% down to 0.01%. For the direct saver account, interest rates are being cut on the 24th of November from 1% down to 0.15%. The junior ISA product is perhaps seeing the most extreme interest rate cut, down from 3.25% to 1.5%. And the direct ISA will also see its interest rate cut from 0.9% down to 0.1%. Again, that's from the 24th of November onwards. The 24th of November also sees cuts to the fixed rate products from National Savings, although those cuts won't be applied until your existing fixed rate product comes up for renewal, so when the term expires and you try to refresh it. For the 1-year guaranteed growth bond, we're seeing the interest rate cut on the 24th of November from 1.1% down to 0.1%, and for the 1-year guaranteed income bond from 1.06% to 0.06%. And again, for both of those, it's at the time your existing product expires. It won't be implemented for existing guaranteed growth and guaranteed income products. There are also interest rate cuts which will affect premium bonds with National Savings. Now, premium bond interest rates are a little bit different. They're not an interest rate which is applied directly to your savings. Instead, it's an interest rate used to calculate the prize pot for premium bonds. And for the December prize draw onwards, we're seeing the interest rate for the prize pot cut from 1.4% being cut down to 1%. And that will mean fewer prizes from December onwards. In fact, 1 million fewer prizes a month from December onwards. It also reduces your chances of winning any prize from that December draw onwards. As things stand with the current 1.4% interest rate, your chances of winning a prize were 1 in 24,500. That's your chance of winning a prize if you hold a £1 bond, for every £1 bond you hold. From December onwards, by virtue of that interest rate cut on the prize pot from 1.4% to 1%, your chance of winning a prize falls to 1 in 34,500. So much less chance of winning any prize, certainly winning the top £1 million prize, if you hold premium bonds. So that's what's happening in terms of interest rate cuts, and you're probably thinking right now, as a National Savings and Investments customer, what should I do with my money that I'm holding with NS&I? And I think there are a few different things to think about. The first, most important consideration always when it comes to cash savings is to shop around. You don't get rewarded for loyalty in the cash savings market. In fact, you get penalised for it. What we often see are banks and building societies, and indeed National Savings, put their interest rates up a little bit to tempting customers to win business from savers, and then over time those interest rates tend to fall and loyal customers are penalised by virtue of staying with one bank, building society or other institution. So shop around, look for more competitive rates. There are some better deals to be had than those now available once these interest rate cuts come in at National Savings. The second consideration is to make sure you don't take undue levels of risk when you shop around. And the thing I'd be very wary about as a saver is moving from cash savings to something like peer-to-peer lending, or indeed some sort of mini bond debt issued by a company. Now, the headline interest rates, it's not really interest, the headline return on these products can look very attractive, particularly in such a low interest rate environment. But actually the risk to your savings, the risk to your capital is many, many times greater than it is with a bank, a building society, or NS&I. So be very, very careful, particularly when you're shopping around on the internet. You might see adverts on Google offering you what look like very attractive headline interest rates. Really, you're placing your capital at a great deal of risk if you do that. So watch out for peer-to-peer lending, watch out for mini bonds. The other consideration for savers in this current low interest rate environment is whether they might be better served moving to an investment rather than keeping their money in cash. Now, the outlook for interest rates, at least in the medium term, the next sort of 3 or 4 years or so, is very low indeed. In fact, the Bank of England, as recently as last week, were talking about negative interest rates as a very real possibility for next year onwards. We've seen price inflation fall to very low levels, so the Bank of England has a little bit of wriggle room in terms of its interest rate setting policy. It could set them even lower than their current 0.1% bank rate. It could go negative in 2021, but I think we're in for a period of prolonged very low interest rates. Now, as a cash saver, you do have to watch out for price inflation. Price inflation erodes the buying power of your cash over time, whereas investments over the long term at least tends to outperform inflation. So if you're thinking about a move from cash to investments, firstly think about your attitude towards investment risk, how much investment risk you feel comfortable taking, whether it's going to keep you awake at night. Secondly, think about your capacity for investment risk. How much risk can you actually afford to take with your money? What impact would it have on your financial life if you were to experience a short-term capital fall? And then thirdly, and probably most importantly, think about your need for investment risk. And you can only really establish a need for investment risk by conducting and carrying out a financial planning exercise. In many cases, you don't need to expose your money to investment risk. You can live with very low interest rates and even with the eroding effects of price inflation over time and still achieve your financial goals. So understand the big picture before you start making really important decisions about whether to move from cash to investments. I hope that's been useful in terms of an overview of these interest rate cuts at national savings and investments, and some things to think about if you're going to either leave your money there or move it somewhere else. I'm Martin Bamford from Informed Choice. You can find out more about the work we do at Informed Choice as a firm of chartered financial planners by visiting our website, that's icfp.co.uk. And if you have any questions about your cash savings or about investing money or about constructing a financial plan, please do get in touch via the website and one of our financial planners will be delighted to have a conversation with you. Thank you for watching, and I hope that was useful.